In this presentation, we're going to consider a sales receipt within the customer cycle. In other words, instead of having an invoice and then receiving payment in the future, we're going to say that we're going to get paid at the same point in time that the work or service or inventory was provided. And therefore, we're not going to have an invoice, but we're going to say a sales receipt because we're going to be receiving the payment at that point in time. Let's zero into it with Xero. Here we are in our Xero demo dashboard. We're going to be opening up our reports. Let's go to our reports and go to the accounting. Let's open up the balance sheet. And as it opens or when it opens, we're going to right click on the tab up top as we always do and duplicate that tab. So we have the report to the left. Then we're going to go back to the reports to the right. And then we're going to go back to the left. We're going to do it again by going to the accounting. We're going to be opening up the income statement. We always like having these reports open, these basic financial statement reports, whenever we do anything. And I'm going to right click on it, or at least I do. That's my custom. And we're going to have these on the right, and then we're going to go back to the left. Okay, so now we're going to go back to QuickBooks Desktop just to consider our flow chart here. So we're in the customer section. You'll recall last time it just depends on the kind of company we have as to the flow of revenue into the company. We may first have an invoice where accounts receivable goes up and we record the other side sales, and then we get payment in the future. You could think of a law firm, a landscaper possibly, or a bookkeeping firm where we do work, then we have to see how much time we spent on it, then we have to invoice at it, and we're not going to get paid until the customer gets that invoice and then pays us some point in the future. Or you can think of a type of business where any business where you can imagine a cash register basically at the front of a store or a food truck or a restaurant. Then you can see that someone might just come up to the cash register and buy something at that point, and we would receive the payment at the same point in time as the work was done, the service was provided. So instead of the invoice having revenue go up or accounts receivable go up, this sales receipt or this type of transaction, we're going to have just cash go up at that point in time. The rest of it will be pretty much the same as an invoice. The other side will be revenue. If there's inventory will go down and we'll have cost of goods sold. We'll have to do a sales tax as well. Now note that this type of business, if we're a store, we're more likely to get something like cash. And therefore, we may not want to put the cash directly into the checking account because it's not in the checking account yet, because we're going to probably have to actually walk to the bank still, which I know that's terrible that we have to do. We can't just scan it in like somehow. But we probably are going to have to walk to the bank, put it in the bank, and therefore we want to put it in the bank in the same kind of grouping as it's going to show up on the bank statement. So that's going to be a problem there. So we could put it into either the checking account at this point in time if we think it's not going to be a problem to reconcile, or we can use that kind of clearing account set up so that we can then put it into a clearing account and then deposit it at the end of the night in whatever format we believe it's going to appear on the bank statement in. Back to Xero. So if we go back to Xero, how would we do that? We're imagining someone's in our store. They just come up to our store. We sell golf stuff apparently, and they're just gonna put the stuff at the front of the store, and they're gonna buy it, and we're gonna get paid like cash. So then I would go to the plus button up top, and I'm gonna go down to the receive money. We're gonna get money at this point in time, which is nice. Now here's where we have to set up our system. Do we want it to go directly into the checking account, or do we want it to put it into the clearing account? So let's first put it into the checking account and test that out. So we're going to say checking account is going to be increasing. And then I'm going to say this is once again from Adam. And then this is going to be happening in, let's say, February 15th. And we're going to say that there's an item. I'm going to try to pick an inventory item again, so that these t-shirts seem to be up and running on the inventory items. So I'm going to pick a black t-shirt, the medium one this time. Medium black t-shirt. That's what we're selling here. Quantity, the quantity we have on hand is 4. Let's say we sell 2 of them. So we're selling 2 of them at $40. That's going to be $80 then on the sales. I'm just going to apply the sales tax. So tax on the sale I'm going to say is $9.25. So that's going to be percent. And so that's going to be the $7.40. All right, so there's going to be a transaction. So what's going to happen here? Well, it's a new receive money. So it's received money. So it's going to be similar to an invoice, except instead of accounts receivable going up, we know that it's just going to be cash going up. And it depends on the account we put it in, either the checking account or some other kind of bank account that we put it into. And then the other side, so it's going to be going up. Cash is going to go up by the full amount we're going to get from the customer, $87.40. Then sales are going to go up, or revenue, or income, whatever you want to call it. However, it's not going to go up by the 87, but only the 80, the amount we get to keep. Difference being the sales tax. $7.40. That's not what we get to keep. That's what needs to go to the government. So whatever government or whatever, the local tough guy, whoever's strong arming us, we got to pay them that 9.25. And so that's going to go into a liability account that we're going to hold and future pay it out to them. And then the other side of the transaction is going to be inventory is going to be going down. So inventory is going to be going down for an amount that's not even on here, but is driven by the service item or the inventory item, just like it was for the invoice. So we won't go into that, but we'll talk about how to set up these items later. And we know the other side is going to be cost of goods sold, the expense account going up, bringing net income down. So just like the invoice, you want this to be as easy as possible. You can imagine someone basically in a register situation, just entering the data. We sold 2 black t-shirts. There it is, $80. They don't need to know how this black t-shirt items was set up. They don't need to know, the cost of it. They don't need to know any of that. They don't need to know all the accounts that are affected on the financial statements when you record this. However, in order to set it up as easily as possible, as we'll see in the future, and we'll do this, we need to know how to set up the item. And if you want to understand how the financial statements work, then you need to know how this data input form is going to affect those financial statements, including, of course, the main balance sheet and income statement. Let's go ahead and record this. So we're going to say save this item. Then we're going to go over to the balance sheet. Let's analyze this. And I'm going to select the drop down. I'm going to bring this out to April should be far enough, and then update this report. Okay, so then we should have the cash going up. Again, our cash is down here in the liability section because it's overdrawn, which is kind of sad. It's depressing me every time I see that, but it's okay. It's going to be all right because we have a big sale happening. We're going to get some money, and it's going to be back up in the asset section like it's supposed to be. And then if we scroll down on February 15th, we have the received money. Notice this is different than the payment received in the checking account. We got the money right into the checking account rather than going through basically an invoice and then a received payment. These source documents are very nice because they're going to tell us what type of document that we have input into the system. You should get an idea or know which forms will be influencing our major accounts, such as the cash account here. So then if we go into this receive item, we got the 8740 here, which of course is going to be our received money for the full amount, 8740. Then I'm going to go back here. I'm going to go back again to the balance sheet. Then I'm going to go to the income statement, which is where the other side should be. So we're on the income statement, and that should be going into income. So let's open up the income line item and scroll down through it. Once it opens up here. So then I'm going to scroll back down and we have the received money, but it's only for $80 right here, right? So there's the $80 amount. That's for the amount we get to keep that doesn't include the sales tax. So then I'm going to go back up, back, and then back. And then I'm going to go back to the balance sheet. And the difference is going to go into a liability account, which is the payable account. This is what we owe the state, the sales tax payable. So we're going to go into the sales tax payable, and then we're going to scroll back down, and once again we've got that item. There's the difference of the $740 that we're going to have to pay in the future. Going back up top, and we're going to go back to the balance sheet, then back to the balance sheet. Then we're going to go up to the inventory. Inventory should go down. So here's the inventory. So we select it's got a negative balance. It's a practice problem, so bear with us as we go work through the demo stuff here. We got a negative inventory. That shouldn't happen. And we're going to scroll down and say that we have this item. And notice it's for $40, and $40 is nowhere on the received payment here, of course, because this is something that we can imagine we give to the client as like our sales receipt, but we don't want the cost of the inventory on it, but we do want it to go down with regards to when we make this form, and it's going to be driven by the sales items. So this will make more sense when we actually add the inventory items. That will make more sense. Notice as we go back to the inventory, the type of accounts or the type of forms that will be affecting the inventory are going to be typically the invoices and the sales receipts. Then I'm going to go back over to the balance sheet. The other side is going to be going to the cost of goods sold. That's on the income statement. So in the cost of goods sold, then let's drill down to the cost of goods sold. We then see the $40 here. So notice everything else is pretty much the same as an invoice with the received money. However, it's not going into the accounts receivable, but going directly into the checking account. Now, what if we want to put this to the clearing account first? Why would we want to do that? let's say we had an example, and let's say we have the plus button and we're going to receive money. So we're going to be receiving money. Let's make this one in March, just so we don't get confused. I'm going to put this into the clearing account. I'll still get confused, but we'll get through it. We're going to go into the clearing account here instead of the checking account. Why would we do that? Because I'm going to say this is from Adam again. Adam's our only customer. Adam. And this is going to be for March. I'm going to put this in as of March, and we'll make it like March 5th. And then I'm going to select an item again. This time we really only need like a service item, so I'm not going to deal with the cost of goods sold. So we'll just have we're not tracking inventory for this one, in other words. And we won't deal with the sales tax either. So it's going to be that $19.95. So all that's going to happen here is it's going to go into the cash account, which is now the clearing account. The other side going into revenue. So this time I'm going to say save and then add another one. So we'll save and then add another one. Just like the other one, an error occurred the following reasons. Tax rate must be valid. Okay, let's go ahead and add a tax on it just to make them happy here. And then I'm going to save it again. And now I'm going to add another one, but it's not going to be just like the other one. We're going to say receive item again. And this time we're going to put it to the clearing account, which is the same that we did last time. So we want the bank clearing account. Next. And it's going to be kind of the same. I'll choose Adam again. That part's the same. Adam is here, and we'll put this on, let's say, I think I did March last time, March 7th. And then this time, good old Adam purchased the white golf ball, a white golf ball. And then we'll add the tax on it because they seem to be very picky about that in this one. So I'm going to add that, and there we have. So now we have these two items. I'm going to save those. Then we're going to go back to the balance sheet, and let's go ahead and refresh it. I'm going to do that by saying update. So we'll update the balance sheet. So now we have it in the clearing account, right? It went into the clearing account, which is this $27.92. Now that $27.92 consists of two payments. You're imagining Adam coming into the store and buying this with cash, right? So he bought this with cash, and we have the two sales, which was the 21 and the 612. We've got $27.92 cash. When we go to the bank, we're going to deposit it in the bank at $27.92. We're not going to make two separate deposits of $21.80 and $612. So that's how I want it to see it in the bank. So that means when I go to the bank, then I'm going to make a transfer now. So I'm going to go, let's bring it back to the balance sheet here. And I'm just going to now transfer it to the bank, imagining we're going to go to the bank. And I'm going to say the plus button down here, transfer. We're walking to the bank at the end of the day with our trusty $27. And we're going to put that into the bank account. It's going to be coming out of the bank clearing account. It's going to be going into the checking account. We're going to do it as of, let's say, March. Let's say 15, March 15. Does that sound about right? Let's do that. And it's going to be for the amount of $27.92, the amount that's in the clearing account. So the full amount that's it's always going to be the full amount, $27.92. It's always going to be for the full amount in the clearing account, because whatever we have in the clearing account represents cash or checks or something we have on hand, and anything we have on hand when we walk over to the bank, we're going to deposit the whole thing. It's not like we're going to deposit part of it. So we're going to say transfer. And again, we could put a reference number referencing the two sales items or referencing the dollar amounts to help us to tie these out. And then, which I didn't do there, but it probably would be good to do that. And then I'm going to update this. So now it went out of the clearing account, and then it's going to go into the checking account, which again is a liability because it's overdrawn. But again, don't worry about it. It's going to be okay because we got money coming in anytime now, and that's going to turn right back to the green. So we're going to be down here in March, and so there's the deposit. So the point is it deposited at $27.92, which is what we expect to be on the bank statement, which makes it easy for us to reconcile those. So if we have cash transactions that we're going to have to walk over to the bank, then you kind of have to do that, or otherwise it's going to be really messy to reconcile the deposit in the bank to a bunch of small cash transactions that you had that are going to group together that somehow tie out to what was deposited in the bank in one lump sum.